Now let's look at how you could do it a little bit differently. Say you didn't want to do the straight line. You're not using the vehicle evenly throughout the entire year. You know that. You're using it some this year, a lot more next year, and you kind of go back and forth. Maybe the best method for you would be the units of production. The units of production is simply based on how much you use it, not on how long you use it. So the only thing what you need to know is how much do you think you're going to use it over its life? So it's easiest to talk about a car again. You talk in mileage. We're going to look at how much am I going to use this vehicle for its entire life? And maybe most people would say maybe 150,000 miles. And then what I need to know is how much am I actually driving it every single year? And I compare that then to my total. So if I thought I was going to drive 100,000 and I only drove 10 this year, 10,000, I used it 10%. So I'm going to depreciate 10% of the vehicle's worth. And I do apologize on the, I just remembered that I don't have my screen share for the full screen. I'm going to go ahead and do that. I'm going to update my screen share. This is what I had for the equipment on my T accounts. I think you could have probably figured out what I was doing, but I just wanted to show that here because I didn't have that up before when I thought I did. Okay, so how we do units production. The step one is exactly the same as the straight line. We're going to first off just figure what our depreciable cost is. Actual cost minus salvage is the depreciable cost. Okay, so that's our first item. The second thing we need to do is take, okay, whatever the cost of it is, divide that by the total number of units that I'm going to be using it. So in this case, maybe miles. Take the cost of the asset and divide it by the miles. That's going to tell you then, for every mile I drive, this is how much I need to depreciate. And then that's what you do here in step 3. Take the cost, how much is it for 1 mile, and then times it by the number of miles you actually drove. That's your depreciation expense. All right, so let's work it out. So everything's the same in our previous example, the $19,000 car, $4,000 salvage value. We no longer need to know the useful life, but what we need to know instead is how much am I going to be driving this car in total, my estimate, and then what am I actually driving it every single year? We can get that from looking at the odometer. Okay, so let's go through the steps. Step 1, exact same as straight line. So step 1 is just going to be the 19 grand minus the 4,000 salvage value. So we're at 15,000 depreciable cost. Step 2, we take the 15, divide it by my total units. I think I'm going to drive it by 150,000 miles. So if I just do the easy math, that means for every mile I drive, it's 10 cents of depreciation. And then what I do is at the end of the year, I add it all up. How many miles did I drive? Multiply that by 10 cents. And that's what I'm going to depreciate for year 1. And then I could get my new book value. So this would be my depreciation expense, and since it's year 1, that would also be my accumulated depreciation. So my book value is simply the cost. We go back up to the 19 minus the 3,500 depreciation. Year 2, when you get to years 2 through whenever, you can skip through step 1 and 2 because they're not going to change. You can go right to step 3, and that's all you need to do. So step 3, I just take 10 cents a mile because it's the same. The only time I would change it is if I had, remember, like I put a new engine in the car, so my actual cost is different now, then I'm going to have to change it. But if that's not the case, then I'm simply going to take the 10 cents a mile times 40,000 miles in year 2 that it gave us in the problem, so 4,000. So I have a total accumulated depreciation now of 7,500. So I take the cost of my asset minus my accumulated depreciation, and 11,500 is my book value. Okay, that's option number 2. Now we're in our third and final option, the double declining method. The double declining method is the most similar to tax purposes. So some companies like to use this to keep in step with tax. What double declining does is it's a little different. It's set up differently. One of the first things to note about double declining is whatever the percentage is for a straight line, you multiply that percentage by 2. So what I mean by that percentage, if you have a 10-year life, for every year you're going to take 10% because 1 year out of 10 is 10%. With double declining, you're going to multiply that by 2, so that's going to be 20%. So let's say it's maybe you had a 5-year life. If you take on your calculator 1 out of 5, that's 20%. In double declining, you're going to use then 40%, 2 times whatever straight line is. And then what you're going to do is you're going to have a different number every single year. So this one is by far the most complicated and the most work. You're always going to take that percentage, the percentage isn't going to change, but you're going to multiply that by whatever the vehicle or the asset's new book value is. So every year it's going to change because that book value is going to go down, down, down. That's how you're going to find the new depreciation cost every year. Now then you think about salvage value. Salvage value isn't even used at the beginning. You're going to stick with what the asset's book value is, not worry about salvage value. The only time you begin to worry about salvage value is when you get down to the end of the useful life, because you do not want your book value to go below the salvage value. And so in that one of those couple final years, your final depreciation expense will have to be tweaked. So let's say your salvage value is 10,000 and your current book value is 11,000. So you only have 1,000 left. But when you did the calculation, the depreciation was supposed to be 2,500. Can't use 2,500 because that would take you below the salvage value. So you only can use the 1,000 in that final year. All right, so let's look at it here. We're going to do the amortization table because basically you have to when you're doing this method. Same scenario when we bought it. A $19,000 note, 4,000 salvage value. We're going to do double declining. Okay, so first thing we got to do is figure out our percentage. 5-year life, so that's 2 times 1 over 5, so 20%. So we're using 40 then, 2 times. With year 2020, and the only thing I want to change here, I forgot to do this, is it gets real complicated if we start doing partial years. So the only thing I wanted to change, and we'll put that here in our notes, is let's pretend that this was made or purchased back early in the year in January, just because it gets way too complicated and we don't need to do that. The book doesn't do that either. So if we bought this at the beginning of the year, we have a depreciable cost of 19 grand. If you took 19, because that is the book value, that's what it's worth, because that's what I bought it. We don't use salvage value yet. 19 times 40%. If you do that on your calculator, you should get 7,600. That's the only amount that I've ever depreciated, so that is my accumulated. And then simply add in the 19 grand, and that's our book value, the 11,400. Now, when we get to year 2, we now use this as our depreciable cost. So that number gets put down here. in 2021. I don't use 19 anymore. I then take 40% of this number. 40% gives me this, 4560. And then if I take the 7600 plus my new depreciation, 4560, that's my new accumulated depreciation. And to get my book value, just simply take my accumulated less the original cost. That's 6840. Now this is where I got to start getting real careful to see if I'm going to hit my salvage value, because I cannot go below, book value wise, 4,000. So I know that if I take the difference between this and 4,000, that's 2840. My depreciation expense needs to be less than 2840. And when I do it, it's just barely less. So I can use the whole amount, because even if I use this, it's not above 2840. It's not going to take me below 4,000. So what I did is I took the 6840 times 40%, and it was just below my cap, the threshold, 2840. And since it was just below, I can use the whole amount. Add in the 2736 to my previous amount, 12,160, and that's my new accumulated. Take that accumulated depreciation, mesh it with the original cost, and I'm left with the 4104 value. Now, when I take 4104 times 40%, I'm going to be really over what I need to be, because I can only take $104 in the final year. Even though this is a 5-year asset, I'm only depreciating it 4 years, because I can't go below the salvage. So my final year, I'm only going to take 104, not the 1641. That gives me the accumulated depreciation of 15, book value of 4,000. Now, we're almost done with the lecture here. I do want to touch on about 3 different things that you're going to find in the problems that are more of a minor subset, but they still are looked at with mining sites. So remember when we said land isn't depreciated? That's true, except for this one exception. If you are actually taking stuff out of the land is not going to necessarily be there or in the same shape as it was when you first got it. So therefore, it's called not depreciation, but it's called depletion. Depletion is you're taking all the wealth out of that land and extracting it, whether it's oil or coal or whatever, and then you're depleting that land. You're going to deplete it very similar to like a straight line. You're going to, or units of production, I guess is a better one. Units of production, you're going to say, I took out 100 units and I think that there's 1,000 units in the land. So therefore I'm going to depreciate, or in this case, deplete, use a depletion expense of 10% of the value of whatever that land is for that mining. Because I took out 10%, 100 out of 1,000 that I think is there. Again, that's just an estimate. I don't know how much is there, but that's my estimate. So that's what mining sites are. It's the one exception to land where it is expensed, and it's called a depletion expense. So we're going to see one of those when we get to the Connect exercises. Something else we're going to see is a copyright. What do you do when you get a copyright? So copyrights a lot of times cost money. Maybe you buy the use, the copyright to something, and then therefore you can use it in your business. That costs you, and that's going to last you, that copyright, maybe 10 years or however long the copyright is. And what you can do with that is you don't, it's not called depreciation, it's actually called amortization. Just a very similar, just depreciation is for things you can touch. Amortization is for intangible things, things that you can't touch necessarily. We are going to amortize the value of that copyright over its legal life, just like with straight line. So if it costs $7,000 and we're going to amortize it over 10 years, we're going to take 7,000 over 10, and so $700 every year, and expense it as an amortization expense. The last thing we're going to talk about here is the what goodwill. Goodwill, not the store, but goodwill is what value that you can't place in any tangible items within a company when you buy it. This is only happens when a company buys another company. You're going to add up all the value of the things that you can touch, including things like copyrights, because that's you can actually put a value on each one of those. And then anything left over that the company, so let's say your assets are worth $1 million, but you sold the company for 1.5 million. Basically, you're saying you have 500,000 of like building up the company work that you've done over the years that you want to get paid for. And that's considered, and that's what's called goodwill. So goodwill is any cost over and beyond the actual value of the assets that you are buying. Now note here, goodwill is not depreciated, but it is recorded as an asset. So I just give us a little example here to finish this out. ABC Corp buys XYZ. After the appraisal of all of XYZ's stuff, they had 400,000 of assets. The building was 300. Equipment was worth 100,000, so 400,000. But ABC paid 600,000 for this business because they really wanted it, and they felt like they had a good customer base, good reputation. All of those things are goodwill. So when we go and put in the dollar amounts, I put in the building for what it's worth, what it's valued at, the equipment, and then the rest is an asset called goodwill. Long-term asset, we don't depreciate it, but it goes on the books as an asset. It's kind of like land, we don't depreciate it.